But auction market theory is a theory, and I do believe auction market theory is going to be a lot popular into the coming trading years as more traders kind of discover what it is, because I think it's one of those theories, and when you apply order flow to it, I think it's one of those things that when you think about it, it logically makes sense. So I think that's why when you come upon it, you will naturally kind of gravitate towards it if you trade futures directionally, specifically something on NASDAQ, because auction market theory is based on the premise of supply and demand. And we're going to get into the actual definition of what auction market theory is, but essentially it is and supply, demand, liquidity. And that's pretty much all a market is. It's not to say you can predict anything, but it gives you the idea of a two-sided way auction. And when we break down what auction market theory, it touches on the idea of price discovery, over an overvalued asset, an undervalued asset, and whatever the case might be. But it really just breaks it down to the basics of what a market in general is and how a market moves. So that's what auction market theory is. And then I also like it because with auction market theory, to be able to trade or be able to build enough conviction to take a trade that you want to take, most everything is based off of volume. So you're not really using any indicators. I guess you can consider volume an indicator, but it is one of those things where it's not like a lagging indicator like a EMA line or a MACD indicator or any of those other indicators. This is just like pure price action, volume, liquidity, supply and demand, and then using order flow, aka reading the tape, to be able to see how buyers and sellers are positioning themselves, and then how the market reacts to those buyers and sellers positioning themselves. And then we try to build a hypothesis on what we personally want to see while building in risk management and where we might want to take profits if the trade works out our way. So that was kind of a mouthful, but let me pull this up. I have a few tabs open, so let's zoom in a little bit. Auction market theory is a framework. I'll highlight it. Is a framework used primarily in financial markets to understand price discovery and market behavior. It conceptualizes markets as a series of continuous auctions where buyers and sellers negotiate over prices. In this context, price movements reflect the collective interaction between supply and demand, and the auction process helps reveal the fair value of an asset. We're going to come back to that term fair value in many ways. One way we can find where fair value is in a chart is by using volume profile. That's why the idea of volume profile and the concept of volume profile and how it lays out the distribution of where most of the trading activity occurred helps us identify where the fair value is, because it shows us the distribution and we find the fair value within the distribution. What does that look like? We'll show some visuals about that whenever we get back into the order flow charts. But just to point out, we're going to be circling back around to that idea of fair value and why that's important. But some key concepts. Oh, right there. Some key concept, value area. The value area is a price range where the majority of trading activity occurs, typically defined as a range where 70% of the volume is transacted. It says 70%, but it's actually 68%. It's actually 68.2. If we're getting specific, it is 68.2%. But that's going to be where the value area is. So whenever we have a distribution, the value area where we're going to have the most volume nodes, that is going to be the value area. And that's where the 70% we keep in mind, that 68.2%. And what that percent stands for is that is where 68.2% of the trading activity occurred in that distribution. What does a distribution look like? If you want to visualize it, just think again of what a volume profile looks like with the volume nodes sticking out. The value area, again, is going to be the area where 68.2% of the trading activity occurred. Okay. So we'll just keep that in mind. And traders see this as fair price range where buyers and sellers are most active. And that's true. That is also why the areas where traders are most active, or where 70% of the trading activity occurred, that's why we tend to have a choppier market, or we're more likely to be range bound whenever we get into that area, because that is where most of the orders were facilitated. And it just makes sense. That's why whenever it does, I don't want to get too much into it right now, but that's why whenever price does leave that area, it has the ability to turn into a trending market, because there's lower volume nodes and the market's a lot thinner. There's less liquidity there. That's why price can just move through there a little bit more fluid. You can think of the high volume node area or that value area as more like molasses. Price discovery, we talked about this a little bit, but let's go back to market profile. So this is a visual tool often used with auction theory. A market profile displays the distribution of trades over price and time. It shows where most trades occur, the point of control. But it shows where most trades where trades occur, the point of control, and where prices spent little time, which is the low volume nodes where we were just talking about, where there's less liquidity. So price tends to trend quicker in those areas and doesn't get stopped up as easy. And then we have price discovery. This is whenever we can really turn into a trending market. Whenever we see acceptance outside of the high volume node area. We haven't talked about what price acceptance is, but we'll talk about that again. But this is whenever price discovery will start to kick in, aka a trending market. So price discovery is a process by which markets find equilibrium between buyers and sellers as the auction progresses, and the market tests different price levels to find a consensus on value. This will make a little bit more sense when we talk about price acceptance and the market accepting this price. But to keep this one short, price discovery again is just whenever the market kicks into a trending mode, and then we'll trend until we start hitting another liquidity level or another aka fair value area. I've been saying liquidity level a lot for those levels, but they're really called fair value areas. There just happen to be a lot of liquidity in those areas. Excess and balance markets, prices trade with narrow range, which is the value area, indicating a balance between supply and demand. That's whenever we'll get a consolidation, a ranging market. These all mean the same things: a ranging market, consolidation, but ranging markets and consolidations become balanced zones. Why do we use the term balanced? Because that is where buyers and sellers are agreeing upon price at that moment. The only time price will move outside of that balanced market is whenever one side gets more aggressive. So short sellers become more aggressive, it could potentially kick us into a trending market until we find another balance, and then vice versa. That's the whole idea behind it. We're gonna skip right down to how traders use auction market theory. On these segments, I try to give a good idea on how I apply auction market theory by utilizing order flow charts, but these are going to be the definitions. This is how traders might use it. So identifying value areas, and this is exactly what I do. Traders watch for value areas, price ranges where the most volume is traded, and use these potential levels for support and resistance. If price is inside a value area, the market is balanced, and traders may expect reversion to the mean. I think I'm going to stop right there in terms of like going through definitions, because that could be a lot just to like, keep going down the thing. Like, let's just soak that in. Also another thing I want to start sharing is I understand I can show a good idea on if you're someone that wants to trade in a ranging market, how I was backtesting like crazy this weekend. And one thing that I didn't like was I was mostly just trading whenever the market moved into an imbalance state. So whenever we got a big trend, so I was like, that's awesome. I was trading the moves or waiting for the moves to where we would get a big move to a new balanced area. But if we keep in mind, again, if we think about the distribution and a value area, 70% of the trading is going to be facilitated in that area. That also lets us know whenever we go from a balanced zone to an imbalanced zone, that means probably 30% or less of the time we're going to get those directional moves. So that lets me know if I'm trading a strategy where I'm trading from balanced to waiting for it to go imbalanced instead of learning how to trade inside the balance, that's going to let me know I'm going to have a lot less trading days. My frequency of trading isn't going to be higher, but the risk to reward is going to be pretty high because the range and the points that I can catch on the moves are going to be a lot higher. But because again, I'm trading them as price is accepted out of the old value area, that lets me know I'm going to get less frequent opportunities because 70% of the time price stays within the value areas. And my trading strategy is not take into account trading the value area. So if it's in there 70% of the time, that means I got to wait for the other 30% whenever it's not trading in there. And then on top of that, that doesn't mean I can just trade whenever it's not in the value area. Then you have to wait for your personal setups on top of that to then take your trade. So if you're only trading those very directional moves, you just have to have the correct mindset and adjust your expectations that you're not going to be trading every day. You're not going to be trading every other day, right? And we just have to manage our expectations based off of what the data is telling us and how distribution curves work. But there is certain things that line up. I'll document in Notebook and I can show examples and you can back test these things. Like whenever you get strong imbalance, like for example, these are certain entry signals that you can look to get short if there's a failed auction at a value area high. We haven't talked about that, but we'll circle back around to this pertains to the conversation we're having right now. If I want to get short and I see strong imbalances on the bid, I see strong volume with aggressive negative delta. I see light volume on the pullbacks with positive delta. I see price holding within the initial balance. Price rallies through VWAP with increased balance. All of those things and then even maybe trapped volume outside of the value area, like all of those things are going to take into account your conviction level and how much size you're going to use. It doesn't mean you have to see every single one of these details before you take the trade. But if you see all of those lining up and you see all of those occurring at the same time, you're going to naturally have more conviction. And if you can find an area to risk off of, you're going to feel more convicted, or you're going to be willing to risk more in that situation. It doesn't mean you're going to make money, but you're going to feel comfortable with risking more and potentially losing that because this was a great opportunity to do so. And then whenever we add the idea, and I don't mean to keep going on a tangent, and then when we add the idea of who really moves the markets, banks, institutions, big money, whoever, not retail, that's for sure. If we really think about it, they use limit orders. 99% of the time they're using limit orders. And it's like, of course they have to fill a lot of their limit orders in the fair value areas. That's where 70% of the trading activity is facilitated. That's the only area where there's enough liquidity for big money to fill their orders. Oh, that makes sense. If they're the ones that actually move the market, it makes sense why whenever they fill their positions or they're done doing whatever they want to do, why the price can then kick into an imbalance state, or AKA price discovery again. But I don't know, understanding the fundamentals is super helpful to connect the dots, and just kind of eye-opening whenever there's just so much fluff that you learn when it comes to just the markets over the years. But if you really take advantage of the softwares that you have and the tools and the knowledge, it can be really helpful.